Hello Maverick Traders, and welcome out to this video on creating a probability cone. I'm Corey Halliday, and we're going to have a lot of fun today. Today we're going to dig into statistics. We're going to show you how to draw a bell curve, standard deviations, create your own probability cones, and most importantly, how to utilize that information and turn it into better trading success. So I think you're going to really enjoy it. Let's start with the statistical side of things by talking about standard deviations. So in this idea of standard deviations, we need to draw a bell curve, and I'm sure you've seen this before, the basic chart. And so a bell curve will look like this. It'll have, your big distribution like this, and this is kind of a normal bell curve. And usually when you look at one of these, you'll have some lines in here that kind of show you where the one standard deviation or 68% of the data is located, something like this. And whatever you're analyzing, this is the majority. Roughly 2/3 of the data falls within one standard deviation. And then maybe they'll put some lines out here even that show the 95% or two standard deviations area. And then anything out here would be tail risk. This only happens 2.5% of the time, or this crazy thing happens 2.5% of the time. So before we get into stocks, let's think about this in terms of maybe statistical analysis of, let's use the height of people, right? So in the US, I think the average height of a male is about 5 feet 8 inches tall, somewhere in that neighborhood. And one standard deviation, think about what the words standard deviation, deviate from the mean, kind of the average area, would be about 3 inches. So let's say 5'11 to 5'5. So what does that mean? What do these numbers suggest? Well, it basically says if you took 1,000,000 people, 1,000,000 males in the US, and you said, what is your height? What is your height? What is your height? And you took all of that data, what you'd figure out is where 68% of all that data resides. And in this case, 68% of all of the males, the men in the US, are somewhere between 5'5 and 5'11. That's the vast majority. And then if you said, well, where does 95% of the data fall? And maybe that falls between 6'2 and 5'2 or something like that. Well, that's two standard deviations, meaning 95% of all males in the US are between those height ranges. And then anything outside of that would be a statistical outlier. And that kind of makes sense in that if you ever see someone that's 7 feet tall, it's something out of the ordinary. You kind of notice and go, wow, he's really tall. That's unexpected. That's not something you see at every moment, right? And so those are lower statistically. And if you were to just walk down the street, most of the men you see are going to be kind of in the average height range. That's the vast majority. So we can take this type of information and use it in statistical analysis for anything. And so what we're going to do is measure volatility. We're going to take these same principles and say, well, how does this apply to stocks? And it does in terms of volatility. So what does that mean, volatility? Well, volatility is one asset might move very little, one might move medium, and one might move very wildly, right? Different levels of volatility. But in each of those cases, you can use the historical volatility to kind of get an expected range. If something moves very little, well, in the future, it's going to be expected to move less. Something that moves more will have a wider band, and something that moves a lot would have a wider band. In each case, this is the 68% probability of where it's going to land. This is the 68%. It's a little wider because it has more volatility historically, but it would still have its probability range. And then even something that's very volatile, while the range will be wider, it would still have its one standard deviation, its probability range that it will land in most of the time. So when we look at that, there are sources that will actually do this work for you. And one of those is think or swim. We use that a lot of times for paper trading purposes and so on. If you were to pull up, in this case, this is a chart of Apple. If I was to pull up a chart of Apple, we did is go to the studies, and you can add a study. And if you come into these studies, if you look at the P's, there's a probability of expiring cone. Now, what does that mean of expiring? Basically, they're going to mark expirations out here, and they're going to say, okay, between now and October expiration, which is 10/21, where is it supposed to be? And between now and November expiration, where is it going to be? And between now and December monthly expiration, where's it going to be? And of course, the more time you give the stock, the wider the band's going to go. So between now and October, there is a 1 standard deviation or 68% probability that it's going to land between here and here according to this statistical measure. If you give it through November, well, of course, it has even more chance for bigger moves, right? You'd always expect that between now and October, the stock's going to move less than between now and November. Give it an extra month and it can move more, either up or down. Give it till December and it can move more, and so on. And so you can see that that probability keeps expanding out. If you say, well, how much will it move between now and January of next year? Well, it's going to be a very wide band because that's a long time. That gives the stock a lot of chance to move very wildly. Now, what think or swim defaults to, if I come over here to the Analyze button, you'll see down here in the model, this is their pricing model that they're using. And this is a standard pricing model, and it's the Bjerkson-Stensland model. If you wanted to change that, a very popular one is the Black-Scholes. It was nominated for a Nobel Peace Prize when it was created by Black and Scholes. Some people think that's kind of outdated. Thinkorswim prefers this one. I'm going to show you a whole new one. I'm going to show you how to use option prices to create your own probability cone. And what you'll normally notice is when you use the one that I'm going to show you, which is the options prices to create your probability cone, it's going to be a little bit tighter than this one. It's going to be a little bit more narrow usually. So if we were to go out, look at this. If I go to October 21st, see this shaded area. Everything in the shaded area is the probability. In fact, let me set the price slices to 1 standard deviation. So that line is out there and that line is out there. Notice if I move this one over here, see how it's 68%. That's a 1 standard deviation. What they're saying is 68% of the time it should fall between 166 basically. Let me get those on the same level there. Between 166 and 131, 132-ish. That's the range. Here's where it's at right now. That's about how much volatility between now and October expiration. If I change this to November, it's going to go out even further, of course, right? Now it's to 172 and 126 and so on. And the further you go out in time, the wider this band will be. Well, look, let's go back to October and see how these numbers match up. Look at these two numbers, 166.50, 132.10. If I go to the chart, it's the same number, 132.10, 166.50. Now, it's changing moment by moment, right, as the stock is moving and so forth, but it's not changing much. It's basically the exact same number here as what you see right here. It's showing you the same thing, just a little different format. Here it's got the prices down here and it's got this shaded area. Or if you go to the chart, it just shows these lines and that's your 1 standard deviation. Look at this, 172 to 126. If I go to November, 172 to 126. 172 to 126. So they're creating that probability of expiring cone. Now we're going to create our own. Watch this. So if I go to Apple's options, why do I like to use the option prices to create my probability cone? Well, number one, I'm trading these options. So how they're priced matters to me. When you put on a trade, you are implying that you're trading volatility. So you're implying that, I think the stock is going to stay within this range, or I think it's going to go outside of this range, or I think it's going to go up towards this area. But you're making a play on volatility, whether you realize it or not, because these options are pricing in volatility. Now, the options market is very smart, and it prices in all of the known factors, right? Everything that is known, such as earnings. Earnings are known. So if this company reports earnings before this expiration, it's going to get priced into those options. The options are going to reflect that the stock could be more volatile based on an earnings report. It'll price in any Fed meetings. It'll price in any analyst day. Anything that could create volatility will be priced into these options. What it can't price in are the unknowns, right? There are always unknowns, and to a certain extent those are priced in because the market kind of gives this little buffer of, hey, there's always the potential that something crazy can happen or what have you. So they'll, that's the idea behind insurance is, well, people are paying for the unknown, for the things that are coming that are unknowable and unpredictable. There is a certain element of that, but they can't price in everything. If something truly catastrophic were to happen to Apple's business, well, maybe there's just no way to know that ahead of time, or something in the economy or whatever. Maybe all options for all stocks are overvalued or undervalued based on whatever is about to come out. That's always a possibility. Now, as we look at this probability cone that we're going to build, first, you've got to choose an expiration to do this. And so let's go back here and kind of talk about the steps. Step one is we need to choose a date, right? We've got to choose an expiration. And we're going to analyze between now and that period of time. So usually there's monthly expirations, there's weekly expirations. The standard is kind of to use the monthlies because those will go out a month at a time. But if you wanted to create on a weekly basis, you could do that. You could create a 3-week probability cone based on all of the next 3-week expirations. You can do whatever you want, but choose an expiration date. Next, you look at the stock price, wherever it's at, and you find what we call the at-the-money strike price. So when you're looking at options, there would be calls on the left here, puts on the right, and there would be strike prices. So let's say that a stock is trading at, 84.20 per share or something like that. Well, there might be strikes. Let's just say they're every $5. 80 strike, 85 strike, 90 strike, and so on. What we're going to do is we're going to find what we call the at-the-money strike, the strike price that is closest to the price of the stock. In this case, that's 85. We ignore all the other strike prices. Ignore all of them. Then you're going to look over here and there will be a bid and an ask for the options, right? And over here on the puts, there will be a bid and an ask. The bid is the buyers. The ask is the sellers. Here's what I bid. Here's what I'm willing to buy this option for. Here's what I'm asking or willing to sell this option for. Let's say that this option is trading for 320 by 340 or something like that. And then we look over here at the puts, and maybe the puts are trading for $4 by 415. I won't make it too simple. All we're simply going to do at this point is basically take the midpoint. Okay, we're going to look at what the 85 strike call and the 85 strike put are going for, roughly in the middle. And we're going to add them together, right? We're just taking the value. This is called an at the money straddle. All you're doing is taking the value of the at the money straddle, the at the money call and the at the money put, and adding them together. So what's the midpoint between 320 and 340? Well, it's 330. And we don't need to be too scientific with this. What's the midpoint between 4 and 415? Well, you could say it's 4.07 or 08 or something. I don't even do that. I just say, okay, in the middle is about 410. Make it easy on myself. This is not an exact science. This is just taking a number that's basically in the middle, which is fair value. You know, the midpoint is probably fair value. It's in between the highest bidder and the lowest seller. It's roughly, you know, where this transaction should go through if you were to place an order. Now, if I add those two numbers together, so I take 410 plus 330, and we have our numbers. In this case, okay, that's $7.40. Now we can build our probability cone. We can say, let's say that this is October 21st or whatever expiration. Let's say that's the expiration we chose. Do we have a probability cone? Yes. Once you find the at the money straddle value, which in this case is 740, you say, okay, the stock is at 84.20 right now. Between now and October, it should go up or down 740 from this level. So let's do it together. Let me pull up a calculator so you make sure we're on the same page. I would take the current stock price at 84.20 plus 740, and that would give us the upper band. In this case, that's 91.60. And I would take the at the money straddle value of 740, or take the stock price and subtract that at the money straddle value. So 84.20 minus the 740. See, I just went plus and minus that number. And now 76.80 is the bottom of the range. And this, according to how the options are priced, this is your 68%. One standard deviation area. According to how the options are priced, this is the range it should fall in 68% of the time. Now, will it fall there every time? Of course not. If it's only going to land there 68% of the time, well, that means that 16% of the time it'll be higher than that, and 16% of the time it'll be lower than that, right? There's 32% left over. So sometimes the stock will go higher than the expected range, and sometimes it'll be lower than the expected range. Not most of the time, but some of the time. Now we've created that. And you can do this with every expiration. So you could do it over and over again across various expirations. Let's do another example, but let's kind of break it down where we could choose different expirations. So we could say October, November, December, and let's say that XYZ stock is trading at, let's change up the numbers. Let's say that it's trading at 112.83. Well, let's not make it too complicated. 112.80 per share. That's its current value, right? That's where it's currently trading. And we want to build a probability cone that says, okay, it's at 112.80 right now, but where is it likely to be between now and October? And then, so here's the October expiration, right? Here's to October. And then this probability cone would keep going out and out to November. And then it would go out even further, again, to December. And it would keep widening out at each expiration. So you could have this probability cone out like that. The question is, well, what are the numbers? we just simply have to go find the at-the-money straddle value for each of these expirations. So hypothetically, let's say that, the calls are going for 5 something, the puts are going for 5 something. Let's say that the at-the-money straddle comes out to $11 roughly. So we would go find whatever strike price is closest to 112.80. Maybe they have a 113 strike. Maybe they have strike prices at every dollar. 110, 111, 112, 113, 114. We would choose the 113 strike because it's closest. And like I said, the calls might be going for 5 something, the puts might be going for 5 something, and so $11 total. Out to November, it'd probably be a little higher, but it won't be double. This is an important concept. Double the amount of time in options is not double the money. You'd probably go from 11 to like 16, and then 16 to maybe 20. So notice there was a $5 increase here and a $4 increase there. So now we've got our, we wouldn't have drawn this yet, but we've got the actual numbers. This would say, okay, 11 added to 112.80 would give us the top of the probability cone. So that should be 123.80, if I'm doing that right in my head. And 11 subtracted from that, so 112, so it would be 111.80, 101.80, I think, would be the bottom of that, right? And then you'd go 16 above this, so that would be like 128.80, and 16 below, which would be 320, so 96.80 if I'm doing that right in my head. And you can check the numbers, but basically, and then $20 above, so that's 132.80, and $20 below, which would put us at what, 92.80, something like that. And so these should be basically your prices, and so you can kind of see how they spread out further over time. And you're creating your probability cone. Again, normally Thinkorswim's probability cone will look just a little bit different. Thinkorswim's will usually be just a little bit wider out here at each of those expirations. Now, someone might say, well, why not just use Thinkorswim's? That's fine. But what's important mainly is that you understand how this works. When you think about directions, I always teach that, most people think that stocks move in 3 directions, up, down, or sideways. And I really disagree with that. I call it 5 directions. And the reason I say there's 5 directions is really because of this statistical analysis. It's because the normal behavior is what most people think of, right? The bullish move, the neutral move, the bearish move. And that is going to happen 68% of the time. But that still leaves 16% of the time for the more extreme, the very bullish, the move that's above the standard deviation, the move that's up here, right? And the very bearish move. And we need to account for those, and we need to recognize when our outlook is one of those. And if our outlook, by the way, you need to put on trades that make sense according to your outlook. So it's really interesting if you talk to a new trader, they'll say, well, I think the stock's going down. Okay. Do you think it's going to be like some world earth-shattering type of move, because the trade you've put on only makes money if this stock just completely falls apart? And as you dig in, they say, well, no, I'm not that bearish. I just thought it was going to go down some. Okay, but you had on a position that required an extreme move. So if you're going to put on an extreme trade, you need to have an extreme outlook, right? Our trades need to reflect our expectations. And so if we were to think about this statistically, we could even kind of break it down in this fashion. We could kind of say, Well, a neutral move is something in here. It would kind of be the stock trading within this range throughout these expirations. Neutral through October would be one thing, and that's different than neutral through November, right? Which would be different than neutral through December. But if you had a neutral outlook, one of the 5 directions, but basically that the stock was going to stay range bound, okay, I'll just highlight this area. This would be your outlook. If you think the stock is going to finish somewhere in here throughout these different time periods, this is what a neutral outlook would look like. If you are bullish, but just normal, just regular bullish, well, then you're probably going to expect, let's see if I can change the color here. I'm not sure I can. I don't think it'll allow me. I'll have to use this. I can't use the highlighter. But if you have just a more normal bullish expectation, then you're going to kind of expect a move up towards this upper boundary, aren't you? You're not neutral. You don't expect it to just hang around 112.80, but you're also not targeting a move above 123.80. You're not targeting a move above 128 through November, right? You're not extremely, like extreme, very, very bullish. However, sometimes you might be that. You might say the market is underestimating how high this can go, how good it's going to be. You can put on a trade for that 5th direction, right? That extreme upside move. In this case, you in fact would build a trade that anticipates a move to 130 through October, or to 135 through November, or to 140 through December. You can put on that trade, but you need to recognize that you are outside of the statistical norm. If I'm putting on a regular average ho-hum bearish trade, I'm probably going to be targeting a move down towards the lower boundary, right? That's regular bearish outlook. Targeting, I'm not betting on the stock going from 112 to $80 per share. I'm betting on it going towards 101 through October, or towards 96 through November, or towards 92 come December. If I am extremely, extremely bearish, well, then I've got to put on a more extreme bearish trade. I probably should have put this as more of the red, but if I go extreme bearish, now all of a sudden I do have this outlook. Well, okay, now I am going to bet on it going maybe to into the 90s through October, or into the 90s to 80s in November, or the 80s to maybe even the 70s through December, right? But I need to recognize that I am outside of the statistical probability. This is your standard deviation. This is the normal behavior. If you start building trades targeting a move above these bands, you are reaching a more extreme outlook, either bullish or bearish. So let's build a couple more of these using actual data, and then come in and compare it to Thinkorswim. So I'll change the chart up. Let's say we were going to use, I don't know, it doesn't really matter what we use. Let's say Target. Okay, Target's trading at 164 per share. That's its stock price. So if I go to October, I need to find the strike price that is closest to the price of the stock. And I'm basically ignoring everything else, right? So with the stock at 164, I'm focusing in on the 165s. That's the at the money strike. I'm simply taking the mid value of the call and the put and adding them together. 680 plus 710. Okay, I'm just taking a number right in the middle and adding those together. And that right there is your one standard deviation value between now and October expiration. It's 1390. Now we take the November at the money straddle value. So I need to find the 165 strike again, and then I need to go, I've changed it to November, and I'm going to add the call and the put together to get my November at the money straddle. Okay, here we've got 10.55 on the call side at the midpoint, right, in the middle of the bid-ask spread. And here I'm going to call it 11.20. And I'm going to add those two numbers together. And that puts us at 21.75 through now and November. Notice twice the amount of time is not twice the amount of money. It moves up, but not, it didn't go from about 14 to 28. It went from about 14 to 21 or so. It's important to understand that aspect of the options market, that there's more premium in the shorter duration options. They have more theta, time decay possibilities. Let's add one more. Let's go to December. Again, I need to go find the at the monies. And the December at the money straddle value is 12.15 on the call, 12.50 on the put. Add those two numbers together, and we now have the at the money straddle value through December. So now I have October, I have November, and I have December. We can create our probability cone, our probability of expiring cone. Now I'm going to take a screenshot of this so that I have those numbers, because I'm going to have to clear this off and I want to remember those numbers, okay? So let's clear this off, come back to our page, and let's build this together. So first, and also remember where the stock is trading. The stock is trading at 164.22, okay? And again, these are areas. These are not exact numbers. So I don't care if you call that 164. If you just say the stock is trading at, target's stock price is at 164 per share. Maybe I shouldn't have used target because that's an actual company. That doesn't suggest that is your price target or anything like that. That could say XYZ. XYZ stock is trading at 164, whatever the stock is. Now, its stock price is around 164. So we need to know, here's target stock at 164. We say, okay, plus or minus, and plus and minus 1390 through October. The at the money straddle value through November is 21.75, and the at the money straddle value through December is 24.65. So what would your probability of expiring cone look like? Well, first we go through October. And we say, okay, 164 plus 1390 would put us at 177.90. And let me show the calculator, and let's make sure. I'm doing this in my head, and I do screw up sometimes. So 164 plus 1390, just show you the numbers, 177.90. 164 minus 1390, just show you the numbers, that's 150.10. Okay, and that's the expected range between now and October. And then of course this line would keep going out further, right? It would keep expanding out. And through November, where is the stock likely to be? What is your one standard deviation? 68% of the time between now and October, it tells us target's likely to be between about 178 and 150. That's the price ranges it's likely to land in. The probability of it expiring inside of there is about 68%. Well, if we build the next one, 164 plus 21.75, and if you wanted to put this at 164.20 where the stock was trading instead of rounding it, that's perfectly fine. I'm just showing you that it doesn't have to be perfectly scientific. 185.75 is the top of any expected move between now and November, and 164 minus 21.75 would give us the bottom end of the range, 142.25. And then last but not least, this keeps expanding out, and we get the December numbers. And the December numbers, 164 share price plus 24.65 equals 188.65. So notice, just going that extra month, it didn't expand out much. It's only an extra 3 points, right? And on the bottom end of the range, we go share price minus 24.65. Whoops. 164 minus 24.65 equals 139.35. So that's the bottom of the expected range. Now, if you put on a trade that makes money if the stock goes to 192 per share between now and November, what is your outlook? Well, in our 5 directions, I hope everyone is answering this question accurately. You are outside of the expected range, so that would be a very bullish outlook. That would be somewhat extreme, like you're saying, hey, I think the market has undervalued volatility. I'm putting on a very bullish, long volatility trade. I think the stock is going to be more volatile and bullish than the market's pricing in. If you put on a trade that says, I think the stock's going to be at 145 per share through October, what is your outlook? Well, hopefully you all answer very bearish, because you are betting that it is going to have an extreme move further to the downside, greater than the expected range. So you are long volatility. You're expecting that the options prices are undervaluing, and specifically to the downside, how much this stock is going to move. Next, if you put on a trade that expects the stock to be at around 160 per share through December, what is your outlook? You have a very neutral outlook. Of course, you think the stock is going to move and move and move, but what do you think it's going to do? That it's going to find its way back towards 160 over the longer term, over the coming 3 months. If you put on a trade at those levels, you have this outlook on that time period. What if you put on a trade that targeted a move to 180 per share through November, pardon me? What if this was your price target? What if you built a call spread that targeted a move to 180? Well, then you have a normal bullish outlook, okay? Well within the realm of probability. Normal outlook. You don't think it's going to stay neutral here. You think it's going to work its way higher, but you're not extreme. You got a typical ho-hum bullish outlook. And what if you targeted a move down to 152 per share through October? Well, then you would have a very normal bearish outlook. You don't think it's going to stay flat here. You think it's going to work its way lower, but it's well within the realm of probability, and it's pretty standard bearish trade. So thinking about that probability cone and what your outlook is and how it compares to the volatility of the options market and what they're pricing in. As a trader, you're profiting really from your outlook and how it might differ and how it might fit. And a lot of times the trades that I put on kind of fall in this category of, I'm not making some extremist bet. I'm not betting that volatility is way too low or way too high or whatever. I'm kind of targeting, if I'm bullish, a lot of times my trades just target a move up towards the top end of the range. So if I'm bullish and I'm building a trade, I might target a move up towards 175. Not all the way to the peak maybe, but towards that level. Or if I'm bullish on the stock through November, I might target a move to 180. Or if I'm bullish through December, I might target a move to 185, right? I expect it to go up, maybe not to the tippy top, but I expect a move towards that area. And most of my bearish trades, guess where my targets are? Probably a move down towards 150. I might build a trade that expects the stock to go to 152, or build a trade that expects the stock to go down to 145. Maybe not all the way to the bottom, but towards that area, or here towards 140-ish or something like that. So utilizing the option prices, how that probability cone is built, and then building your trades accordingly. Now let me show you, again, if I take a screenshot of this, let me just take a screenshot because I want these numbers that we built in. Because I'm going to go to targets chart, and I'm going to show you that this will differ just a little bit with the Thinkorswim default chart. Let me show you what I mean. So if we go plug these numbers in on target, I'm going to kill this, and we go to analyze, and in fact, let's go to the chart because it'll show these numbers for target. Okay, here's where target's at 164. And here's the top and the bottom through October and through November and through December. And guess what? Our numbers are going to be slightly different utilizing the option prices. What did our number come out to right up here? Well, it came out to 177.90. That's different than 181.75. And the bottom one came out to 150.10. So do you see that our probability cone is a little bit more narrow utilizing the option prices? And this is almost always how it works. And our numbers came out to 185.75 through November and 142.25 through November. So you see how we're a little bit inside of that. And guess what? It'll keep going just inside. This one was 188.65. And this one was what was it? 139.35. I can see from my little screenshot on my other page. So see how it's just inside there. And what you'll actually notice is that regardless of what stock you pull up, most of them, if you were to go out and calculate the at-the-money straddle for the options, like I'll choose SPY here, the S&P 500 ETF, what would the probability cone look like for the option prices? It would be something like this. It'll be just kind of inside that, just a little bit. And then this one would go up to here, and this one would go down to here, or whatever, and so forth. And it would look very, very similar to the what is Thinkorswim's, the Bjerkson, what do they call it? The Bjerkson-Stensland pricing model, right? Now, if I were to change it, if we go Black-Scholes or whatever, it would change what this probability looks like a little bit. So if we go to SPY and we look at these numbers, okay, 378 to 389. Well, let's go out to October. Let's do this. Okay, 416 to 350. Now, if I go back, it's close but not the same. If I go to this one, again, it's close but not the same. It just changes these numbers a little bit. If we use the at-the-money straddle, it just changes the numbers just slightly. And it usually creates a little bit more narrow range for one reason or another. Now, is this one more accurate? I mean, I don't know that there's one that's more accurate at really depicting where the stock is going to be. I would say that as a general rule, the options market is probably overvalued most of the time, but then has some enormous blowups. And it's kind of in the favor of people that do pricing models to kind of build a little bit wider band than is actual reality, just to kind of have a little bit more safety net and a little bit more protection against the blowups. But the reality is if you look at the options prices, those are what you're trading. And these are what, you know, the statistics, you can say, well, I really believe in the Black-Scholes model for statistical analysis. And so I think that's its better range. Okay, fine. But you're still trading these options. And this is how they're priced. And this is what you're paying. And so if you are trading volatility strategies like straddles and strangles and things like that, these are the actual prices you're trading, right? This is what is reality in the market. So I like to do that, build probability cones, and then think about how my outlook applies to that probability cone, where I'm targeting. If I was trading SPY, and I had a pretty normal bullish outlook, I'd probably expect a move up here towards 410 through October. And if I were pretty standard bearish, I'd expect a move down towards 355 or something. And so on and so forth, right? Those would be some reasonable targets in terms of my outlook. So make sure that as you do this, you use that information and utilize your and build your trades according to your outlook. So we will leave it there. This has been a really fun class on building probability cones. I hope you enjoyed it. On behalf of Maverick Trading, I'm Corey Halliday. We'll see you next time. Goodbye, everyone.